Welcome back to the Investing Markets and Money podcast from the Armchair Trader. And this week we're talking about royalty companies. And in the studio with us, we have Brett Heath, who's joining us from Metalla Royalty. He's over from Canada, and we thought we'd take the opportunity to sit down and have a bit of a chat with him about what royalty companies are, and specifically about Metalla Royalty itself as a very good example of this. So welcome to the podcast, Brett.
Thanks for having me.
So really to start off with, can you give us a quick background on Metalla Royalty, and particularly how it started and the journey it's taken to get here, and maybe also explain a little bit about what a royalty company does in the process?
Sure. So, I can summarize our business in one sentence. And what we like to do is we like to go out and buy mispriced optionality on tier one geological trends around the world, and let the operators really do all that work to bring it in production. And we do that through royalties. And royalties are these financial instruments that give you a free carried, non-dilutive interest in a mining asset in perpetuity. So you buy a royalty on a different property. It could be in production, it could be in development, it could be in exploration. But once you buy that 1, 2, or 3% royalty, usually they're very small interest on these assets, then you own those in perpetuity. They can't be diluted, they're free carried. And once the asset goes into production, then you get top line cash flow. So in an environment like we are in today, you capture 100% of that margin. There's no dilution, there's no CapEx, there's no OpEx, but you get all the benefits of the expansions of the assets, you get all the benefits of the discoveries on the assets. All of the upside comes with these royalties and how they function as part of these mines. But you don't have any of the kind of downside, like the bigger risks, the risks and the operations headaches that kind of come with operating a mine.
And what happens when the mine gets bought? So like best case scenario, a lot of these smaller mines are acquired by a major player. Do you still keep that income stream, or does it go with the acquisition?
Yeah, so the royalty stays with the asset itself, which is a great thing. So a lot of the royalties that we have been bought by bigger mining companies. A focus of ours has always been to own royalties on assets that are already operated by the biggest mining companies in the world. And as a royalty company, you don't operate anything. So you live and die by these operators. And so it's critical, I think, to have the best operators in the business, advancing your asset through exploration, development, and ultimately production and operations.
And so you really have to know the market really well to be able to do something like this.
You do. You have to have a pretty good understanding. And, when we started this business back in 2016, we started with nothing. We had no assets, no cash. We had a good strategy, a great idea, and we went out and executed on it. And over 8 years, we acquired 100 royalties through 32 different transactions. And now that is what we have in our portfolio today.
And do you tend to hang on to them all once you've got them? I mean, presumably if that's an income generating contract, the temptation is to never really transfer them out of the company again.
Yeah, there's very, very little costs in managing a portfolio of royalties day to day. Once the royalty itself gets to a place where it's in production, there are some costs associated with kind of auditing and monitoring those royalties that are producing. But generally, that's a pretty fixed cost. So when you look at royalty businesses in general, they are some of the highest kind of cash flow to employee metrics as you can get. Like today, our company only has 6 full-time employees, a couple part-time employees. So you can operate a business that is, I think our market cap today is around $700 million US. And we've got a business that, it's in its growth phase right now, but from a revenue perspective, it's pretty substantial given the amount of people that you need really to generate that type of value.
Well, that market cap has advanced considerably since we last met a few years ago.
Yes, yes.
And how do you go about, on a practical basis, how do you go about sourcing the deals? Because obviously this is part of the edge of the business, is getting the right deals there.
So for Metalla, we knew that we needed to figure out a way to compete because we could not compete from a cost of capital perspective with the rest of the industry. And so when we were growing our business from nothing, we needed to figure out kind of a way to go out and be able to have a different strategy, kind of a competitive edge, if you will, that we could execute and really do better than everybody else. And one part of the market at the time that was not being fully understood, I would say, was this existing royalty market. So these were the same royalty assets that have been around forever, but they were originated prior. So we actually didn't go out and buy these royalties from the actual underlying operators that operate the mine. We found other companies that held these royalties or individuals, and that was our way to be able to build, what I call now our foundational portfolio. And that was kind of goal number one for our business. And it takes time to do that. Obviously, when we raised our first we did our first financing for this business back in 2016. I told the stakeholders that were seeding the company, which one of them is still one of our largest shareholders today. At that time, it's going to take about 10 years to really build out a royalty portfolio that will have duration. And we're coming up on 10 years, and I feel like I'm pretty confident we've got a great foundational portfolio with duration, growth, longevity, and a lot of optionality that is kind of embedded. And optionality is something that is not you. It's difficult to quantify when you're buying it. It's a bit more of an art than a science, if you will. But if you have a good process and you have an understanding of kind of what makes up great optionality, then you can buy some really great assets that take time to generate value, but it can provide superior returns.
And looking at the next 12 to 24 months, what would investors be able to expect from the company going forward? Presumably sourcing more of these kinds of deals?
Well, so the royalty business is an interesting one because there's times where you want to be really aggressive, and then there's times when you don't. Right now, we're in a different part of the cycle. Mm-hmm. So first 8 years of our business, we did 32 different transactions. I think it was the most out of all sector, public or private, from a transactional perspective. And then the last 18 months, we've done none.
Right.
And part of that was it just didn't make sense. We were in a part of the cycle where there wasn't a lot of value being attributed to development. Most of our portfolio was in development, and the market wasn't giving development a lot of value at the time. The market was really prioritizing and giving value to producing assets. When an asset is in production, typically it's pretty well known. It's pretty well understood, and there's not a lot there that could be upside, if you will. I mean, you get the metal price upside, you get the revenue, that's great, but then you've got to redeploy that back into other assets. And when you're doing that in a part of the cycle like we're in right now, where gold is now sitting over $4,000, that's a difficult place to be. So we took a different approach. And I can give you an example of this. One of the royalties that we bought about 5 years ago is a royalty on what is basically the third largest gold mine in Canada now. It's this asset called Cote in Gosselin. And IAMGOLD, the operator, which is still the operator today, was building a mine. And the CapEx, the expected CapEx, was 2 or 3x over what they told the market. So it was not a very good situation for a bit of time. but they did get through it, and now it is producing a ton of cash. But during this process, they made a discovery on this property about 1.5 kilometers north of their existing mine, which at the time held 7+ million ounces of reserves. Now, this discovery was called Gosselin, and we recognized that when they were exploring on this property, some of the intercepts that they hit were some of the best that we've ever seen. And so we quickly went out and acquired the royalties that existed on that property. And we bought those royalties for about $6 million USD. We bought a 1.35% over that part of the project. Now, that part of the project covers all of Gosselin and then a small part of the Côté mine. Now, fast forward to today. So this is about 5 years after we made that purchase. That asset, Gosselin, now hosts approximately 7.4 million ounces of gold. Okay, and there's another 100,000 meters that has been drilled over the last 24 months that will be incorporated into an updated reserve and resource, probably in the first half of 2026. And our expectation is that that's going to significantly increase. Now, what does that mean for our shareholders? Well, that means that we bought something for $6 million. We didn't know exactly how big that was going to be when we bought it, but we had a pretty good idea that it was a meaningful ore body that we were getting exposure to. And just at the 7.4 million ounces, that's approximately 117,000 gold equivalent ounces to our account as of today. And that will go up, I think, pretty significantly. Or if you think about it from an after-tax revenue perspective over the life of the asset at consensus prices, which is around $2,800 today, that should kick off somewhere in the range of 250 million USD over the life of the asset. And this asset's already in production on Côté, so Gosselin will be integrated by 26. But that is how you get those big wins. That is how you go out and you buy the mispriced optionality. And so we've got 100 of these things in the portfolio, and a lot of them are still not very well known. Not everyone is going to be a Côté and Gosselin acquisition, that's for sure. But we feel very confident that there's definitely going to be more big upside opportunities within this portfolio.
Oh, that sounds absolutely amazing. And it's interesting that the royalty companies often fly under the radar with a lot of investors, because here in the UK, people are very focused on individual miners, but actually you bring that spread of quite a nice diversified portfolio of different opportunities without the operational risk, as you've been saying. Is it all gold and silver, or do you have other types of mines as well there?
So our portfolio is approximately 2/3 exposed to gold and silver and 1/3 copper.
Right.
So we're really bullish on copper. Copper was a metal that we introduced in 2023, and gold and silver is what we started with. So very focused on these three metals. We feel that it's difficult to be experts across the entire commodity spectrum, and we want to know the most about the metals that we live in so we can make the best decisions and we can be most effective executing our business around that.
Understood. And are there any other operational jurisdictional risks that you face as a royalty company versus, say, more traditional miners?
Well, the benefit of the royalty companies first is the diversification aspect approach. Like, even if you take some of the largest mining companies in the world, they may give you exposure to a dozen or maybe a little more than a dozen assets. As a smaller royalty company, we've got 100 different royalties in the portfolio. So it gives you good broad diversification, which is always really important when you think about your downside risk. Now, in the royalty business, there's a lot of optionality, but in order to capture that optionality that I spoke about, the critical piece to doing that is time. And so you want that so much of the value is created over time with these royalties that you need to be in jurisdictions that have that duration that line up with the assets. And so jurisdictions that have really good property rights are absolutely critical. Because if you miss that time part of it, that can kind of take away all of the benefits that royalties in your portfolio have.
Yeah, I can imagine someone decides they're going to nationalize the mining sector tomorrow. That can be problematic.
It's something to think about.
Mm.
I mean, our royalties are in North America, South America, and Australia. So those are the jurisdictions that we're in. But as gold starts to play more, call it a more influential role in the global financial system, which is where I think we're at today. Like we're watching the transition of that today. And you're seeing gold kind of slowly surpass the U.S. Treasuries as the de facto global reserve asset. And as gold becomes more important within the global financial industry and community, then there's a lot of big gold mines that are in jurisdictions that those countries may see those assets as means of national security, and they may take them. I mean, my position is that I think that geopolitical risk is not fully priced into a lot of the sector. So, but we stick to not only the good jurisdictions, but we stick to the best operators. We think that's also very, very important in managing the risk because, as a royalty company, again, you don't produce anything. You don't do any mining at all. And so you rely on these operators. So great operators, and then kind of the third thing that we focus on is the great geology, the proven geological trends around the world, and owning big chunks of that.
And how do you assign and monitor the operators you work with?
Well, there's not a ton to monitor on these royalties until they come into production. Now, we closely monitor the advancements of the assets, usually on a quarterly basis, because that's when most big public companies, obviously report and provide updates. And we, obviously have a means of gathering intel in many other sources that allow us to be a bit more competitive. But there's not a significant call it amount of bandwidth that is required to be able to kind of monitor these assets. That's why they're so great. You have a small kind of highly functional team that goes out and acquires an asset, and then they go and acquire another one and another one. And once you acquire them, you can, whether it's a portfolio of 30, 50, 100, 200 royalties, you can for the most part manage that with the same amount of people.
And I appreciate you haven't made that many acquisitions recently, but what are the criteria that you look for? And, could you conceivably see something you like right now, and despite the cycle that we've spoken about, and still go for it?
Yeah, so I think Metalla is at a bit of a different stage. And I think when you look at the royalty business and you look at executing this business, there's kind of some milestones that have to be hit. And some royalty companies were formed via spin out of major mining companies, or they had big portfolios to start, or maybe a big kind of tier one producing asset. So they had a bit of a head start. But you have to kind of get the company to a place of critical mass, and that means depth within the portfolio. That means growth, and that means revenue. And that's where I feel our business is at today, because we're a bit of at an inflection point where we've bought all of these assets, and all of these assets that we bought, understanding where we saw the optionality that was being mispriced, we're a little bit earlier stage. Well, fast forward 3, 4, 5 years, all these assets are coming into production. So this will be the first kind of meaningful year, I believe, of positive operating cash flow. And we should see that expand in a pretty material way in 26, 27, through the end of this decade. And with that, now we have access to credit. And so when you look at kind of scaling your business as kind of call it a more of a mid-tier or a kind of middle size type of royalty business, that's where you really get the torque because you can use credit and you have the operating cash flow to get access to the credit and pay it down and basically minimize the dilution that happens in the early days. So in the early days, every single acquisition we made, we had to finance. Um, we didn't have a big cash flowing type of portfolio. We were buying a lot of really attractive assets, but a lot of them, as I said, were pre-production type of royalties. And so now that we have access to credit, we can use that credit as a tool to continue to grow and scale the business. So primarily that is really the focus today is looking at kind of larger producing type of operations, but sitting in a place where when you're in this part of the cycle, you're not forced to do that because again, like royalty companies, the most successful ones always play the cycles. They're very, very aggressive and then they're not. And then they're very, very aggressive and then they're not. And the market tends to give you these windows where it is very preferential for the royalty companies to deploy capital. And it doesn't mean that you can't deploy capital in the other part of the cycle. I mean, there are opportunities that always arise. We're actively looking for those opportunities right now. But having the luxury to not be forced or feel forced to deploy that capital in a part of the cycle where you're not necessarily going to get the best return for your shareholders, I think is a good place to be. But we had to go out kind of in advance and plan for that. And through the years, that wasn't always the best. That wasn't always favored by investors. Like it wasn't, over the following previous 3 years, development was heavily discounted by the market. The market wanted and was giving value and attributing real value to basically producing assets. And that's kind of it. So I think we're in the middle of that shift right now, maybe even in the early part of that shift. And the market's starting to kind of take a look at, and royalty businesses and even mining businesses are kind of looking at this because, if you didn't go out and secure your growth assets, when times were tough, then it's really, really difficult to do it now.
Yeah. Do you see much consolidation in the royalties market in Canada?
So there's been a lot of consolidation already. What we've seen is one of the mid-tiers was just acquired by one of the major mining royalty companies. So that was actually the largest M&A transaction in the royalty business to date. And we've seen a lot of the junior royalty companies getting acquired. And that really started over the last kind of probably 4 years, but continued on. So there's a lot fewer royalty companies today than there were 4 years ago.
I can see the attraction for bigger players, basically, if you've got a good portfolio already. Why not? Yeah, no, that's very interesting. If we look ahead to the next sort of 3 to 5 years, obviously difficult to forecast what the commodity cycle is going to do, particularly gold and silver. But presumably you'll, wait for the next cycle when you can start aggressively acquiring further royalties again. And is your ambition to grow the business and just become like a major player in the space?
Well, we want to do whatever is the right thing to do to maximize the value for shareholders. So in this market, what does that mean? That means to still be looking for opportunities, but have a disciplined approach to what that looks like, to make sure that when you are deploying capital in this part of the cycle, that it really does make sense on a per share basis. But ultimately, I feel that we have the team to scale this into a multi-billion-dollar business. We have the tools and we have access to credit. We've got a portfolio today that is expected to grow from a production standpoint at a 35% CAGR, compound annual growth rate, through the end of this decade. So what does that mean? That means that our production for 2025, our midpoint of our guidance this year is 4,000 gold equivalent ounces. So if you take an average $3,000 $3,200 gold price. That's around 12, 13, 14 million USD. And we expect that production by the end of this decade to be probably somewhere in the 20 to 25,000 gold equivalent ounce range. Now, the average reserve life of our top 10 assets is 20 years. That's the
Wow.
reserve life.
Yeah.
So if you think about what this business potentially can kick off, now, we don't know exactly when all of these different assets are coming into production, but we have a pretty good idea that they will, because they're very meaningful to the underlying operator's ability to replace their own ounces that they produce in the reserves and so forth. And so you're looking at a business that, if the gold price stays just flat from here on out, will likely kick off, I think, over 100 million a year of top line with a 20-year reserve life, and probably expanding kind of beyond that. So it's exciting to kind of think about, like, that is what this business has the potential to generate if we do nothing for the next 5 years. And that's the power of the royalty business. Now, if you think about what our portfolio represents, in a high level summary, if you take the average royalty rate across our whole portfolio, it's about 1.6%. That covers 690,000 hectares, which is bigger than the state of Delaware. And the ounces that it covers is approximately 100 million ounces of gold. And to our account is that 1.6%. And so the gold attributable to our company is about 1.6 million ounces.
And that is absolutely amazing. And do you get paid in cash from the mining companies, or do they actually give you the output from the mines themselves?
Most of the time it's cash.
Right.
Most of the time it is cash. There are some agreements, mainly on the streaming side of the equation, that they actually do deliver the physical bullion. But the exposure to the bullion for our shareholders is in the ground. And I think that having exposure to gold in the ground, if it's in a good jurisdiction and it's got a great operator that owns it, that has the financial capabilities to be able to pull that gold out of the ground on behalf of the royalty owner, then that is the safest way to own it, I think, because you can't steal it. No one can take it. If it can't be confiscated by governments. I mean, technically, I guess it can, but not in the jurisdictions, not likely in the jurisdictions that we're in. And then as that gold comes out of the ground, you get all of that benefit, and you get all of that optionality. When you think about kind of where gold was when we started this business, it was sitting around $1,200 an ounce. And we bought royalties on a number of different assets, but one example is we bought a royalty on a producing asset in South Dakota that's operated by a mining company called Coeur Mining. And at the time when we bought this royalty, the mine life was only 6 years. So we bought this royalty, we modeled in 6 years of production, and gold was much lower. Like I said, at that time, it was probably around $1,400, $1,500 an ounce. Now, as the gold price goes up, these mining companies start to look at these operations a little bit different. And a lot of the resources turn into reserves, and a lot of the waste turns into resources. And ultimately, what that means is that mines are expanded. So between now and then, you've got an asset that had 6 years. It's been in production for about 6 years. It's got close to 10 years of mine life that exists today, and they just doubled the resources on that asset. So here's a mine that we bought with a 6-year mine life, and potentially maybe it goes for, in total, 15, 20 years.
So very long-term assets, which you could almost park in your pension fund in a way.
Yeah, and that's again like when we're buying these things, we're thinking about all of these different aspects of what potentially will be material benefits on these assets. Like what is the market missing?
Mm.
And again, going back to kind of the original statement, like what have we been doing? We've been going out and buying mispriced optionality because the market today, or the business that we're in today, is so focused on the numbers that they forget about kind of how to really think about these assets and generate the value through capturing that optionality, which is originally kind of where the royalty sector came from. The first royalty company was a company, great business called Franco-Nevada, and their first acquisition was on a royalty that they paid $2 million for, and they still hold it today, still in production, and that royalty is kicked off over $1 billion in free cash.
Crumbs.
Yeah, and
Yeah.
those are the types of things that those don't come along very often. But when you look at our Cote and Gosselin royalty, I mean, it's got pretty good potential. It's got pretty good potential. It's still expanding, and could that asset kick off 3, 4, 500 million over the life of the asset? Like, there's definitely potential. We don't know kind of as of yet today, but it's pretty promising.
And I've got just time for one more question. And I want to step back and just, from your perspective, ask you something I've been told by a lot of people in the market is that there's been underinvestment in the gold and silver mining sector, the junior mining sector, these sort of new projects that are coming on. And that as a consequence, we're really not going to see that sort of production, sufficient production coming online to really make a dent in the gold and silver prices as they stand at the moment. Is that something from where you're sitting you'd agree with?
Yeah, that not only has the sector, specifically the exploration part of the sector,
Mm.
been generally starved of capital, I would say, for the last 15 years. If you go look at new discoveries, like new material discoveries over the last 25 years, they are down significantly. So it's not only a function of not having the capital to go explore, but it's more of also a function of, uh, call it the low hanging fruit around the world, in regards to the deposits that were near surface and easy to find. If you go think about like the discoveries that are happening today, where are these big discoveries? Well, it's all under significant cover. It's all very, very, very deep. You look at the discovery that Barrick just made on 4 Mile. That is an unbelievable discovery. But when it's sitting 3, 4, 500 meters below surface, it's very, very difficult to know what's happening down there. And it's very, very difficult to drill
Yeah.
because each hole that you put in the ground is $500,000 to $1 million. And how can an exploration company, which is so limited from a capital perspective, find these types of deposits? So the answer is yes, and I think that is ultimately what has been driving a lot of the M&A, because a lot of these big companies, you look like a company like Barrick, which at one point in time was the largest gold company in the world.
Yeah.
If you go back 15 years, they were producing 7-8 million ounces a year, and today they're kind of around 4 a year, and that is with a couple material M&A acquisitions, basically putting other big companies together with it. So it just kind of goes to show it's very, very, very difficult to replace 1 million ounces a year. It is insanely difficult to replace 2 or 3 million ounces a year. So, again, like part of our process, thinking about it, was getting exposure to these big ore bodies, these proven geological trends around the world, because we knew that these types of areas were the ones where people would look for new gold and people would advance these assets in production because there's so few of them still left out on the planet.
That's really interesting. Thank you very much, Brett, for coming on and telling us a bit more about royalty companies and indeed also Metalla royalty and streaming. It's been very interesting.
Yes, thank you. Thank you for having me.
You've been listening to the Investing Markets and Money podcast. We've been talking to Brett Heath of Metalla Royalty and Streaming, which is listed on the New York Stock Exchange and on the Toronto Stock Exchange under the MTA ticker.
The content of this podcast is for information and entertainment purposes only and does not constitute financial advice. The views and opinions expressed by guests or hosts are their own and do not necessarily reflect those of the Armchair Trader. Investments can go up and down in value, and you may not get back the amount you originally invested. Past performance is not a reliable indicator of future results. We do not provide any personal investment, tax, or legal advice. Always do your own research or seek independent professional advice before making any financial decisions. The Armchair Trader is a media company and is not authorized or regulated by the Financial Conduct Authority.